So good afternoon and welcome to Mutual Fund Corner. I am Anisha Jain and with me is Ekta Batra. Every Tuesday and Thursday we will answer all your mutual fund queries and equip you to create wealth by benefiting from the magic of compounding.
Okay, and we will bring you in touch with all the top financial advisors who will analyze your portfolio and provide recommendations as well. But first up, let's get a quick check in terms of the markets and let's see what's going on there. In fact, it has actually been a day where we have managed to build on gains. We have the mid-cap index, which is up around 0.8%, and we have the bank nifty, which is up around 0.4%. In fact, the nifty, if you see all of the intraday charts, the mid-cap index is at the high point of the day. We have the nifty bank, which has picked up pace along with the nifty and the sensex. So there is that follow-on buying which has come in after yesterday's big up move that we saw. So that should be the key point to note. Otherwise, in terms of stocks which are moving, Indiabulls Housing Finance stands out. That stock is up around 5.5%. We have Tata Motors, which is up around 2.5%. In fact, it's a very healthy advance decline ratio in general. So we have around 1,300 stocks advancing to around 959 stocks which are declining on the Bombay Stock Exchange. But let's start with all of the top stories that we're tracking this afternoon, and then we'll get to answering all of your mutual fund queries. First up, markets continue yesterday's short covering rally led by Reliance and ICICI Bank. Metal stocks too rise for a second day. Mid-cap index outperforms, rises to the day's high.
A clutch of PSU banks surge on receiving capital from the government. Corporation Bank and Allahabad Bank lead as the likely candidates to exit the prompt corrective action list next.
Bharti Airtel and Idea Vodafone drag after data shows a drop in subscribers in the month of December. Reliance gains after Jio adds over 85 lakh users in the same period.
Well, Tech Mahindra announces a 1,950 crore rupee buyback, future capital allocation policy to include buybacks as well as dividends. Street also awaits the Jet Airways EGM. Remember, on the agenda includes increase of share capital and approval to convert debt to equity.
And we have the Reserve Bank Governor who's going to be meeting bankers this afternoon to discuss transmission of rate cuts. Experts feel the banks may not cut rates immediately as deposit growth remains weak.
Okay, joining us today we have Kalpesh Ashar of Full Circle Financial Planners and Advisors to answer all your mutual fund queries. Good afternoon, Kalpesh. Thank you so much for joining us. So let's get started and bring in a first query. And I think this one is the caller. Bhupen Dattani writes to us from Kolkata. He has investments in multiple funds and wants to assess his portfolio. He also wants suggestions on a debt fund. Kalpesh, if you could help him understand what he should do regarding this debt fund question that he has.
I think the debt fund which he's asking for, he's looking for a provision, just to keep his emergency cash, or what we call the contingency fund. And ideally, we would suggest that that is kept, in an instrument which is easily accessible and you can get the money within 24 hours. So the options lie between keeping the money in savings bank or in a liquid fund and nothing more beyond that. So first, I would like to say that, off late, there has been a lot of turbulence in the debt fund and especially surprisingly in the liquid fund category as well. So you can, ideal would be that you keep 50,000, which you have 50% of that in savings bank and the 50% in liquid funds. But make sure that you have a horizon of at least 3 to 6 months when you keep the money in a liquid fund, considering the situation right now. So you could, might as well divide that and keep the contingency fund which you have.
Okay, all right. Well, let's get to another query now. We have Mr. MC Muthaya who calls us from Chennai. He wants recommendations on some high quality liquid mutual funds that is equal to savings account. Hi, Mr. Muthaya.
Hello, good afternoon.
Afternoon. Your question?
My question is, could you please suggest some high quality liquid mutual fund which is equivalent of savings account so that I can keep the money and earn the better interest and I can draw the money as and when required. Okay. And it should be very safe also.
Okay, fair enough.
Thank you very much.
All right, Kalpesh, so Mr. Muthaya is retired. He's around over 55. What would you recommend in such a case?
See, considering just previous question which was there was on the liquid fund category. Yeah. And Mr. Mutaya is right that being a retired person, he needs the element of safety and accessibility both together. Now, if he wants something better than an option, which is the savings fund, which he wants to keep, obviously liquid funds is the answer to that. But that comes with a little bit of a caution, as what we are experiencing. There have been, 3-4, I would say, financial accidents which have happened in the liquid fund space, that we've seen that liquid funds also facing turbulence because of the bad quality of papers which were defaulting or downgraded. So keep that element in your mind, that liquid funds also are prone to that element of risk recently. So that needs to be kept in mind. And obviously, it will give you a better rate of return than a savings account. And in that, I would suggest you can look at the Aditya Birla Sun Life Liquid Fund and also the ICICI Prudential Liquid Fund. You can divide that between the two. But understand that this also needs to be divided between the two funds, and don't concentrate everything in one liquid fund right now. And this is easily accessible to you whenever you want it. So keep the money only in liquid fund and not in any other type of debt fund, which has some element of high duration paper or an exit load embedded in.
Okay, so keep the money in liquid fund. That's the suggestion coming in from Kalpesh. But moving on then, Puran Pante writes to us from Dubai. Now he has 1 lakh rupees in his hand and wants to know which schemes to invest in. Kalpesh, what would you advise him? 1 lakh rupees in hand and wants to invest it?
First of all, if he's writing from Dubai, I would assume he's an NRI. And being an NRI, I think, you have a different way of looking at things. But it's very good that he is wishing to start his mutual fund journey with a small amount. And obviously looks like a person, entering the mutual fund foray for the first time. The first things he has to, do is get his KYC in place, get his FATCA compliance in place. And obviously, being an NRI, you will have to, submit your overseas address proof, your passport copies, and do whatever is required to get yourself compliant. Once you are through with that, I would suggest that identify the purpose and the goal with which you are beginning to invest. And once that is clear, be it 1 lakh or whatever amount you wish to increase in time to come, you will be very clear whether you want it for the short term or the long term. And once that is determined, the product immediately comes into picture. So if it's anything below 3 years which you're looking for, then debt funds is the answer for that. Or if you wish to start for the long-term journey, that is 5 years and above, then equity funds is the obvious answer. And in equity funds, I think being a fresher, you would not want to take a high level of risk. And in that, you should start ideally with a hybrid or a balanced fund, as we call it, and an index fund. Because even if there is a fall or if there's some type of volatility, I think the negative effect will not be that much as you would face in a multi-cap or a mid or small cap if you venture out in that. But most important, Puran, is identify your goals, because you will be more focused when you start your journey. And being a first timer, I suggest if you can take the help of a proper advisor or a planner, he will guide you through, because being an NRI, your goals and your outlook towards finance and what you want to divert towards your country here needs to be more channelized.
Okay, fair enough. So that's the answer coming in from Kalpesh. Let's get in another query now. We have Mr. Shah Menon, who calls in from Mumbai. He has investments of close to 30 lakh rupees right now, but is worried of on the dividends, basically on the back of falling NAVs. Mr. Menon, go ahead.
Yeah, good afternoon.
Afternoon.
Yeah, see, I had invested in HDFC Balance Advantage Fund, which was earlier the HDFC Prudence Fund merged with the HDFC Growth. Okay, now I find off late the NAV has been falling more than 10%. So my worry is, though they are giving me dividend monthly, is it coming from my principal?
Okay, fair enough.
Should I continue in this scheme or should I redeem out?
Okay, well, Kalpesh, I'm sure a lot of people are sharing this kind of worry right now, especially for Mr. Menon. He's retired, I understand, and he's around 65 years of age. And the first thing you want is that your principal should be protected. So in such a case, what would you recommend? Is this a possibility also? And should he probably shift his funds to maybe debt or a safer mechanism?
Mr. Menon, unfortunately, I'll have to tell you, you're not in this alone.
Yeah.
Because like what Ekta correctly mentioned, that, the fund which you've mentioned has been, projected almost a couple of years back as the one which would give you a fixed type of a dividend, and many people, I think, fell for that, statement which was made. But the fact is actually what you've understood. It's actually eating out of your principal amount. And in a falling market, that is very hazardous, because unlike an FD or a share, which you get interest or a dividend, in a mutual fund, whatever is paid out to you as dividend is then showing as a deduction from your NAV the very next day. And if there's a falling market, all the more worse, because the values already are eroding on its own. So this is a pretty simple call that you need to get out of this structure. And if you want a regular income, which I understand, you should opt for the systematic withdrawal plan. So ideally what we suggest is that post your investment, if it completes 1 year, you shift into a growth mode from the dividend payout, and you fix up a systematic withdrawal plan. So ideally you should expect say 6% or type of a return on the investment as a dividend payout. Now that type of a thing will give you a regular payout which will suffice for your cash requirements which you have, and also will not eat into completely your capital which you are looking for. And as far as the amount which you've invested, I sincerely would suggest you that you redeem 50% of it. Let 50% remain in the said fund which you have and avail of the systematic withdrawal plan. But the remaining 15%, you can shift it to a fixed income where you have at least a surety that you're going to get that regular income, and there is not going to be any patch or any danger to your capital. And for that, I think you can move out, in fact, of the mutual fund space. Being a senior citizen, you have the government senior citizen scheme, where you have a limit of 15 lakh rupees. And in that, the existing rate of interest is around 8.7% per annum, though taxable, but it is a surety. The interest is paid out on a quarterly basis. So that way, at least you will be assured of that much income, and there is no risk to that capital which you will invest.
Okay, so dividend payout option might not be the best way to go forward, but keep an eye out on the markets as well, because Nifty is practically sitting at the 10,800 mark, and the mid-cap index has now piled on gain of over 1%. A few stocks that we need to pull up on our screens. Indiabulls Housing has gained around 1.5% in the last few minutes. Sun Pharma has seen a sudden spike, as well as if you look at Bajaj Finance as well as UPL, there's a sharp uptick coming in all these counters, and these are the ones that are pulling the Nifty higher.
Well, picking up pace definitely for the markets, looking good for the screen. Mid-cap index is up around 1%. We have the Nifty, which is up around 0.5%. And definitely a lot of stocks, broad-based kind of participation coming through. Indiabulls, Vedanta, Tata Motors, ONGC, all of those stocks from different sectors, as you can see, are gaining and are a couple of the top gainers on the Nifty. On the downside, Bharti Infratel, which is down around 2.5%. But let's get in another query now. And Jaya Balan writes to us on Facebook. He wants to know the best mutual fund for ELSS investment in tax saving and wealth management. Kalpesh?
You've used two very broad terms. So tax saving and wealth management. Let's stick to the tax saving, because wealth management is a subject on its own. So if you were just looking at a normal ELSS fund, then I would simply suggest you can look at two funds. So one is the Mere Asset Tax Saver Fund, and the second is the ICICI Prudential Long-Term Equity Fund. And one thing you need to understand, that once you get into an ELSS fund, the funds are locked in for a period of 3 years, and which is in fact the shortest lock-in period you will find in the Section 80C of the IT Act. So if you wish to divide the investment, you can do that between these two funds and get your Section 80C in place.
Okay, so that's the word coming in as far as Mr. Jaybalan is concerned. But moving on, Mr. A. Sarvadeva has emailed us his query. He has investments in multiple funds and wants to assess his portfolio. Kalpesh, I believe we have his portfolio, and it seems like he has diversified his portfolio quite a bit already. He's invested into a lot of mutual funds. What would you advise him?
In fact, sorry to say, but he's diversified too far and too many. And when you diversify too far and too many funds in a mutual fund portfolio, you're actually, nullifying the main structure of a mutual fund, because by nature, a mutual fund would diversify for you. Right. So genuinely what you need is just max of 4 to 6 good schemes in your portfolio. And one more thing, Mr. Sarvadeva, is in your portfolio, you've gotten too many of the hybrid balanced fund categories. So I think somebody looking at the age profile and your risk profile has given or suggested you so many repetitive, hybrid funds. It seriously doesn't make any sense, because they will just duplicate the, entire stocks which you have in your portfolio and just add to the paperwork. So right now it looks a very, very long portfolio. I would suggest that you just narrow it down to 4 to 6 funds. And if you have the allocation for equity, 2 balanced funds, which I would suggest is your ICICI Pru Balanced Advantage Fund and the SBI Equity Hybrid Fund, which you already have. Stick to those 2. And in the large cap space, to cover the large cap segment, you can look at the HDFC Top 100, which is also there, and the Aditya Birla Sun Life Equity Fund, which I suggest from my end. That will give you a good combination of the balanced fund, large cap, and the multi-cap categories. So I think that is one thing. And other thing is, if you're not in need of the dividend payout, which is 50% of your portfolio, convert that to the growth option and start a SWP on a systematic withdrawal plan basis.
Okay, all right. Let's get another query now. Mitesh Patel has emailed his query. He has investments in multiple funds and wants to assess his portfolio. He's quite young. He's 33. His goal is wealth creation for 15 to 20 years, and he has multiple SIPs that he's investing in. So maybe we can just pull those up in terms of the SIPs that Mitesh has. Mirai Emerging Blue Chip Fund, Kotak Standard Multicap, Motilal Oswal Multicap, and SBI Small Cap. What would you recommend?
Mitesh, let me compliment you that the funds which you've selected per se are good performing funds with a good track record and a good pedigree. But all of them fall under the bit of an aggressive mode. And although you have a good time frame, you're young and you've got a 15-20 year time frame, just to keep the balance in the portfolio, what I would suggest is that any one of these funds, they're all equally aggressive and all are equally good. Take a call of replacing any one of the fund with an index fund or a large cap fund. So that will give you a little bit of stability in your equity portfolio going ahead. So even you could add, if you have the additional income, as in one more SIP in an index fund or a large cap fund.
Okay, Mitesh, hope that answers your query.